All right, let's get straight into it. Welcome to today's Explainer, where we're unpacking a highly critical daily strategy report for July 29, 2026. Today, we're cutting right through the headline noise to look at a massive structural fracture happening literally as we speak. We're talking about a severe, violent repricing of global asset models, driven by a total disconnect between the Federal Reserve and the bond market. If you want to know what's actually driving your portfolio right now, well, you're in the exact right place.
Here is our roadmap for today. We'll kick off with macro sentiment and foundation, then move into treasury and currency dynamics. From there, we'll dissect the equity market's microstructure, cover sector rotation and alpha, lay out a strict strategic action plan, and finally wrap it all up with the final verdict. Let's dive in.
Section 1. Macro Sentiment and Foundation. So, the absolutely crucial thing to grasp right now is that the market narrative has completely flipped. Just a few months back, we were all pricing in this manageable mid-cycle expansion, right? But today, the foundation is cracking. We are looking at a full-blown crisis of central bank credibility going head-to-head with entrenched geopolitical inflation. Just look at the timeline of today's price action. It perfectly captures the exact moment the market literally stopped listening to Chairman Warsh. At 2 p.m., the Fed announces they're holding rates. The press conference kicks off at 2:30. But by 3:30, the market totally overrides the rhetoric. Long-end yields violently spike as traders start pricing in physical, on-the-ground realities. Throw in the massive tech capex data that hit after hours at 4 p.m., and you've got the perfect storm for a market breakdown.
Sure, the Fed officially held rates steady, but underneath, the consensus is fracturing. We had three key dissents today from Logan, Hammock, and Kashkari. This exposes a deeply divided committee that's absolutely struggling to contain sticky inflation metrics that just refuse to cool off. This internal split is a huge, glaring signal that the whole higher for longer thing isn't just some catchy phrase anymore. It's a structural reality we have to deal with.
And the market's reaction was brutal. Directly defying the Fed's neutral stance, the 30-year Treasury yield violently surged to 5.16%. That is the highest level we've seen since 2007. I mean, wow. When the long end of the curve moves this violently, it's screaming severe distress. It shews a profound lack of faith that the central bank can actually keep long-term inflation in check.
Chairman Warsh stood up there and claimed they were united, that they have all the tools they need for price stability. But the bond market, it effectively called his bluff. The market didn't buy the rhetoric for a second. Instead, it immediately priced in higher term premiums, effectively outsourcing monetary policy straight to the yield curve.
Moving right along to Section 2. Treasury and Currency Dynamics.
Today, the yield curve gave us a textbook bear steepener. So what does that actually mean in practice? Well, two-year yields dropped 6 basis points, while long-term rates simultaneously shot up. This specific move is a massive red flag for rising inflation fears, and it highlights an aggressively expanding term premium. Ultimately, a steepening like this threatens to completely choke out bank profitability. And why should you care? Because it tightly constricts broader financial conditions across the board. Capital is getting exponentially more expensive, regardless of what target rate the Fed sets.
When we cross-reference the data, a really dangerous anomaly stands out. Look at energy. Despite all the talk of a Middle East ceasefire, WTI crude oil is stubbornly sitting above $90 a barrel. It's up 28% since July 1st. That bakes in this sticky supply-side inflation that completely contradicts the Fed doing nothing today. And at the exact same time, the S&P 500 closed down 1.2% at 7,408. The traditional correlations we are so used to seeing between these asset classes, they're completely breaking down right now.
Let's dig into Section 3. Equity Market Microstructure.
Look beneath the headline index numbers, and the anatomy of today's equity sell-off reveals a highly vulnerable, dangerously concentrated market. The destruction was honestly severe. The Magnificent Seven stocks alone wiped out nearly $800 billion in market value just today. But here is the kicker. This was not retail investors panicking. No, this was mechanical, institutional deleveraging. It was driven by margin calls and risk-parity funds being forced to rebalance as those long-end rates surged. Even the solid blue chips got dragged through the mud, closing well below their 50-day moving averages.
Which brings us to a massive structural question. Are we seeing a repeat of the dot-com telecom overbuild? Markets are now fiercely questioning the real return on investment for the massive capital expenditures needed to keep the AI narrative alive. Because when borrowing costs soar the way they are right now, those multi-billion-dollar outlays suddenly look a lot less like engines of growth and a lot more like fatal balance sheet liabilities. That leads us right into Section 4, Sector Rotation and Alpha. Tech margins are absolutely under siege. The staggering capital burn rates we saw in the after-hours session are historic. Microsoft is projecting up to $260 billion in CapEx for fiscal year 2027. Meta just narrowed their massive range to up to $145 billion for 2026. With higher memory prices and severe component shortages aggressively bleeding these margins, the market is punishing them. I mean, just look at Meta taking a 6% dive after hours.
So the structural rotation here is abundantly clear. Institutional capital is hitting the exits on cash-burning software and semiconductor names. Where's the smart money going? It's migrating aggressively into hard assets, precious metals, and energy infrastructure, specifically MLPs. These are the assets actually capable of absorbing a sustained global supply shock and persistent, sticky inflation.
All right, Section 5, Strategic Action Plan. Let's pivot from the macro view to some immediate, actionable portfolio adjustments you need to make. Institutional allocators absolutely must cut nominal fixed income weightings and liquidate passive index growth. You want to heavily overweight Treasury inflation-protected securities, or TIPS, along with physical gold and MLPs. And honestly, any intraday bounces we see, use them strictly as liquidity events to get out of concentrated tech positions. You need to pay very close attention to this technical level. The S&P closed at 7,408, which means we are already operating below the critical risk pivot of 7,468. Any further downward momentum really threatens to trigger a 0 days to expiration, or 0 DTE, options gamma collapse. Think of it like a mechanical trapdoor. If this technical threshold gets fully breached, forced algorithmic selling will aggressively accelerate this market sell-off. You need to purchase S&P 500 downside puts to hedge this delta exposure right now.
And finally, Section 6, the final verdict.
So, bringing it all together, the brutal convergence of monetary policy paralysis, tech overcapitalization, and sticky commodity inflation forces us to decisively downgrade broader market risk. Our revised institutional model strictly demands an underweight stance on nominal duration and concentrated growth. You've got to reallocate fiercely toward real assets and inflation-protected securities. The whole era of just blindly buying the dip on passive tech indices, that's suspended for now as we navigate this harsh new reality of capital costs.
There's a quote from today's analysis that really hits the nail on the head. Market participants are learning to play the ball, not the referee. The market has decisively stripped the Fed of its forward guidance premium. The referee basically lost control of the game today. You have to trade the physical realities of the yield curve, the actual supply chain bottlenecks, and those massive CapEx bills, not the empty rhetoric coming from a press conference podium.
So as you adjust your portfolios for tomorrow's session, the most urgent question is this: have you adequately shielded your capital against a new economic regime where the central bank no longer dictates the cost of long-term money? Take a hard, honest look at your exposure, respect those technical thresholds, and get ready for continued volatility. Thanks so much for joining this explainer, and we'll see you next time as we keep tracking these massive structural shifts.